In May 2024, Target cut everyday prices on about 5,000 frequently shopped items, and in February 2026, PepsiCo followed with lower suggested prices on many snacks, in some cases by nearly 15%. This video is about why both companies reached for the same affordability move after years of consumer pushback, and why the cost of that choice showed up in very different ways. It solved the affordability problem, but it created an execution and margin problem. By fiscal 2025, Target's operating income had dropped 8.1% to $5.01 billion, while PepsiCo linked its reset to product cuts and manufacturing line closures. That gives us the chain from pressure to price move, to early logic, to slow damage, to the point where a simple answer turned into a harder operating problem. The backdrop for both decisions had been building for a long time. From 2020 to 2024, the All-Food Consumer Price Index in the United States rose 23.6%, and 2022 brought the fastest annual increase in food prices since 1979. Even after that peak, food-at-home prices still climbed 11.4% in 2022, 5.0% in 2023, and 1.2% in 2024, which meant consumers were not reacting to one bad stretch, but to several years of tighter budgets and more careful shopping. Reuters also reported in May 2024 that people were delaying purchases, waiting for deals, and spending more on activities outside the home. For more breakdowns like this, subscribe. The next figure changed the picture. That pressure reached each company in a different way, but the message was the same. Target reported comparable sales, down 3.7%, in the quarter that ended May 4, 2024. Reuters said that made it the fourth straight quarterly decline, which told us shoppers were already pulling back. PepsiCo's problem showed up one step earlier in the chain. In the fourth quarter of 2025, core revenue included a negative 2 percentage point impact from volume and a positive 4.5 percentage point contribution from pricing. So revenue still had help from higher prices while fewer units moved. One company was losing retail momentum. The other was leaning on pricing while demand softened, and both were running into the same consumer mood. Target responded first, and it did it in a way shoppers could feel right away. On May 20, 2024, the company said it would lower everyday regular prices on about 5,000 frequently shopped items across its assortment, and it added that roughly 1,500 items had already been reduced, with thousands more planned through the summer. That was not a short promotion or a coupon event. It was a reset of regular shelf prices on basics people buy all the time, and Target said the move would save consumers millions of dollars over the summer. Unlike Walmart, which maintained pricing stability during this period, Target chose direct price competition as its primary strategy. The company did not stop there either. By October 22, 2024, Target had extended the same play again, announcing regular price cuts on more than 2,000 additional items for the holiday season, after saying it had already lowered prices on more than 8,000 items year-to-date and expected to exceed 10,000 by the end of the season. PepsiCo's move came later and worked differently. On February 3, 2026, it said it would lower suggested retail prices on many snacks by up to nearly 15%, including core brands such as Lay's, Doritos, Cheetos, Tostitos, and Ruffles, with the new pricing beginning that same week. Suggested is the word that matters, because PepsiCo also said retailers would still decide the final shelf price, which meant the relief could vary from store to store. That difference mattered more later. Target's reasoning was easy to follow once we look at what management said at the time. In May 2024, Target CEO Brian Cornell said consumers were feeling pressure to make the most of their budgets, and cutting regular prices on basic items directly addressed that pressure at the point of purchase. Then, on its second quarter 2024 earnings call, Target said that after reducing prices on about 5,000 frequently purchased items over the summer, it saw acceleration in both unit sales and dollar sales trends in those businesses. That kind of result is exactly what a retailer hopes to see when it lowers prices on repeat purchase items. The early read looked encouraging. Another part of the logic sat in Target's scale. The company said its Target Circle loyalty platform had more than 100 million members and added over 2 million new members in the second quarter of 2024, which gave it a large base of shoppers it could reach repeatedly as those lower prices rolled out. Reuters also reported in May 2024 that Target was laser-focused on getting back to sales growth and was tying much of its near-term hope to planned sales events along with price cuts. That meant the affordability move was not sitting off to the side. It was one of the main levers in a broader push to get traffic and spending moving again, especially as private label competition intensified across grocery and general merchandise categories. The next earnings period showed why that seemed reasonable. PepsiCo's logic was different in form, but not in substance. In February 2026, PepsiCo CEO Ramon Laguarta said consumers had been clear that rising everyday costs were making daily decisions harder, and the company presented lower suggested prices as a way to reduce that strain where it could. While Coca-Cola maintained its premium pricing strategy during this period, PepsiCo chose affordability as its competitive lever. The financial backdrop explains why that answer made sense. In the fourth quarter of 2025, PepsiCo reported $29.343 billion in net revenue, with total reported revenue up 6% and core revenue up 2%. So the business still looked large and stable on the surface. But underneath that, the mix was less comfortable, and that is where the pressure really sat. Volume had started to weaken, while pricing was still doing part of the work. And that is a combination that can hold up revenue for a while without fixing demand. In the fourth quarter of 2025, PepsiCo Beverages North America showed organic volume down 5 percentage points. Frito-Lay North America showed volume down 2 percentage points, and PepsiCo Beverages North America also had a 7 percentage point contribution from effective net pricing. That told us the company had been getting help from price while unit demand lost momentum. A selective price reset could look like the cleanest way to protect long-term demand before that pattern became harder to reverse. By fiscal 2025, the cost side had started to show. Up to that point, the original logic still held together. But by fiscal 2025, Target's gross margin rate had slipped to 27.9% from 28.2%, and that changed what the affordability strategy was really costing. From there, the story stops feeling like a clean consumer win and starts looking more like a bill that arrived a little later. The annual report made that plain. Fiscal 2025 is where the trade-off became visible at Target. Full-year net sales fell 1.7% to $104.08 billion from $106.06 billion in fiscal 2024. Operating income dropped 8.1% to $5.01 billion from $5.06 billion. The company said the lower gross margin rate reflected, in part, higher markdowns and purchase order cancellation costs. A price cut looks simple when it is printed on a shelf tag, but inside a retailer, the cost can come back through margin, through merchandising pressure, and through extra charges that were never part of the original customer message. The logic still made sense. The math got harder. The pressure on Target had started well before the broader reset could do much to help. Reuters reported that comparable sales fell 3.7% in the quarter ended May 4, 2024, and the same reporting said Target's share of U.S. retail sales slipped to 1.8% in 2023 from 2.1% in 2020, based on Kantar calculations. So the company was not just trying to make basics cheaper, it was also trying to hold traffic, defend relevance, and recover some momentum after a longer period of weaker performance. That changed the risk in the move, because cutting price while comps and share are already under pressure puts more weight on the same decision. The same tension showed up at PepsiCo in a different form. PepsiCo's slow damage did not run through markdowns, because that is not how the business works, but the strain was still easy to spot. In the fourth quarter of 2025, PepsiCo Beverages North America posted organic volume down 5 percentage points, and Frito-Lay North America was down 2 percentage points. Pricing still added support, which showed the company had been leaning on higher prices as demand softened. Once that happens, a later price cut no longer reads as a simple consumer-friendly gesture. It starts to look like a defensive move meant to keep a volume problem from hardening into something structural. That is a different kind of cost. Reuters made that clearer in December 2025 when it reported that PepsiCo's affordability plan included trimming nearly 20% of its U.S. product lines by early the next year, closing several manufacturing lines, and making structural changes that would affect some jobs. The same report said PepsiCo planned to give an update on its supply chain restructuring review in late 2026, which tells us the company was not only changing prices, it was also reworking the system behind those prices. If Target's bill came through lower margin, higher markdowns, and purchase order cancellation costs, PepsiCo's bill came through simplification, line closures, and a narrower product mix. After that, a quick reversal stopped being easy. This is where the outcomes begin to separate. Target lowered everyday regular prices itself, right at the shelf, and later widened those cuts across more holiday items, owned brands, and national brands, which gave it direct control over execution inside its own stores. PepsiCo lowered suggested retail prices, but it also said retailers would still set the final shelf number, so the actual consumer experience could vary even when PepsiCo's own guidance stayed the same. The shared decision type was real, but the control point was not. That one structural difference shaped the bill each company ended up paying. For Target, the point of no return came when the affordability message became too broad to quietly unwind. What began in May 2024 as lower prices on about 5,000 items had turned into more than 2,000 additional cuts by October, after the company said it had already lowered prices on more than 8,000 items year to date and expected to exceed 10,000 by the end of the holiday season. Once a retailer teaches shoppers to expect that kind of value position across basics, owned brands, and national brands, it becomes harder to step back without disappointing them. At the same time, fiscal 2025 had already brought lower sales, lower operating income, and a thinner gross margin rate. That is when the commitment stopped looking temporary. PepsiCo reached its own point of no return when affordability moved beyond price and into operations. By February 2026, the company had announced lower suggested prices on core snack brands by up to nearly 15%. But Reuters had already reported in December 2025 that the broader plan included cutting nearly 20% of U.S. product lines and closing several manufacturing lines. Once those changes begin, the move is no longer just a short-term price adjustment. The business itself is being reshaped around a different balance between price, volume, and cost. And because retailers still control the final shelf price, PepsiCo had to accept the harder version of the same bet, change the system first, then wait to see how much relief the shopper would actually feel. When we compare the two, the split is not about motive or personality. Both companies were reacting to years of consumer strain, including a 23.6% rise in the All-Food Consumer Price Index from 2020 to 2024. And both were dealing with shoppers who had become more deal-driven and more selective on everyday purchases. The difference is where the cost surfaced. At Target, it showed up in fiscal 2025 through a 27.9% gross margin rate, higher markdowns, purchase order cancellation costs, and operating income down 8.1% to $5.01 billion. At PepsiCo, it showed up through weaker volume, retailer dependence on pass-through, product line cuts, and manufacturing line closures. The same move made sense. The bill landed in different places. A price cut after consumer pushback can rebuild trust quickly, but it also exposes where a business is vulnerable once the customer wants relief and the company still has to protect the model underneath. For a retailer, that cost can run through margin, markdowns, and profit. For a manufacturer, it can run through weaker volume, dependence on retailers, and the need to simplify the business so lower prices are even possible. That is why this comparison matters, because the divergence came from structure, not personality, and structure is usually where the real story sits, reasonable at the time, costly in the end. There are more decisions like this. Subscribe.